Hi, Tasty Nation and Investor Nation. Today I'm going to talk about how to sell premium in the US Treasuries. So the example I'm going to give today is using the 5-year notes, and the symbol for that is /ZF. In the past, I've shown trades with ZN, which is the 10-year notes, but today I'm going to do the 5-year notes. And if we look at IB rank here, here's a screenshot from Tastyworks that a friend of mine sent me. Unfortunately, we don't have Tastyworks yet in Canada, but I had a friend send me this screenshot of all the futures products. So these are arranged in order of highest IB rank to lowest IB rank. And you can see /ZF, which is the 5-year Treasury notes. The IB rank is at 51.9. So that's really high. It's over 50. So this is a product that I would be looking to sell premium in. There's some other products here: Aussie dollar, Canadian dollar, Japanese yen, and I already have some positions in some of those as well. And then the other thing you can notice here is the liquidity ranking is 4 stars. So you know this is going to be a great product to trade in terms of liquidity. So I want to sell premium in /ZF, and I submitted my trade to Tom and Tony, which they talked about on their fast market segment that they do every Friday morning.
Thomas, we're back, my friend, and you know what that means. Time for a little bit more tasty trade. And we've got the fast market coming at you, Sosnoff.
I'm Tom Sosnoff. He's Tony Batiste. This is Taste Trade Live. Thanks for spending the morning with us. And this is Fast Market. Let's do it. It's 8:49. We got to go fast. Dr. Z from Toronto. Oh, good to hear from the doctor. The good doctor. Looking at the 5-year notes. High implied volatility in the 5-year notes. Let's see, 42 days out in March. Sell, what does he want to do here? The 1575 put
and the 18.5 call in March for around 23 ticks.
Well, it's 25 ticks today, 24 ticks.
Well, the more ticks you get, the better off you are.
Yeah. 24.5 ticks, Dr. Z. Wow. Okay, cool. I like that. Something new we haven't traded.
Yep.
Okay, cool.
All right, good job. And you finished on time. Awesome. We'll be back in 90 seconds. This is Taste Trade Live.
Okay, so you can see that Tom put on this trade really quickly. It doesn't take him long to make a decision on whether or not he wants to do a trade. It had high IB rank. It was very liquid. This is a product we're familiar with. And now I'm going to show a demonstration of how I would put that trade on in my platform. Okay, so here we are in my IB trading platform, and I have a chart up of ZF, which is the 5-year Treasury notes. And the infinity symbol here means the continuous contract or the front month contract, which is currently March 31st. And if I look at the options chain here using the Tasty Trade mechanics, the closest to 45 days is 41 days to expiration. That contract actually settles to the June futures. This is the March expiration, which sells to June futures. You don't really need to know that. All you really need to do is look at the days to expiration. So I happen to already have a position on in these, but if you ignore that position, I'll pretend I'm putting on a new position from scratch. I always start by looking at the delta. So for example, if I wanted to do a 1 standard deviation strangle, I would look at the 16 delta. So the 16 delta right now is the 115.75 strike. If I click the bid on that, that's selling the 115.75 put. And if I look for roughly the 16 delta on the call side, that's the 119.25 strike. So the markets have moved a little bit since Tom and Tony did the trade and since I originally put on this trade, but that's okay. That's just how it works. You always have to enter a position based on what the market is doing right now at this time. It doesn't matter what it did in the past or what you think it might do in the future. The probabilities are what they are. So this is the 15, roughly 16 delta on the call side. So that's a strangle. I'm selling an out of the money put and I'm selling an out of the money call. And if we look at the margin impact here or the buying power, this will cost me $1,600 to put on this trade. Markets are not open right now, but it looks like it was trading for a mid price around 180. So what does that mean? Tony calls that ticks. He would call that 18 ticks. So US Treasuries trade in fractions of 30 seconds, but the options trade in fractions of 64ths. So that's 18 64ths. And if I pull out my calculator, 180 divided by 640, which is the same thing as 18 64ths, that's 281. And the multiplier on the US Treasuries is 1,000, which is $281. Now, if you didn't know that, don't worry. You don't have to memorize any of that. The platform calculates all that for you. So you can see here, my credit that I'm receiving is $281, and I'm putting up a buying power of 1,633 to start. So that's a fairly good return on capital. If I did 281 divided by 1633, that's around 17% return on my capital in a period of 41 days. So that's a pretty reasonable trade. This is what the Strangle looks like here. So I want the price of the 5-year note to stay between 115.5 and 119.5 roughly. And the max return I can get is the full credit that I'm receiving here. So 281, it says 250 here. I think that's just because the market's closed right now and these numbers are not super accurate. So my break even there is 115.5 and 119.5, and I will make that max profit. Now, of course, I'm not going to hang on to this till expiration. I would use the regular Tasty Trade mechanics. And if you haven't seen my video on the Tasty Trade mechanics, make sure you check that out. I talk about management, how we would manage this trade. So it's a 76% probability of profit. That's a really great probability. And if I only aim for about half that $281 or $140, that really increases my probability of profit as well. That would be what we call Pop 50, and IB doesn't have Pop 50 on the platform, but if you had Tastyworks, that's a really good feature of Tastyworks that shows you your Pop 50. So the probability of receiving 50% of your profit. Okay, so I've submitted that trade, and as you can see, I already have a Strangle on in ZF, so I don't think I would add to it. But you can see the market has moved since I put this on. Usually when I put on a Strangle, I try to be neutral because I don't like to put my opinion into my trades so much. Really, the probabilities are what they are, regardless of what I think about it. So the markets have moved a little bit since I put on that Strangle. So right now I'm actually short the 116.5 put and short the 119.25 call. Market has moved down a little bit, I guess, since I put that on. So if I put that trade on originally around the 16 or 20 delta, my put is now at the 27.7 delta. So I'm not worried at all yet. But if ZF started to go down and my strike there started to get tested, I could just roll down this call like I've shown in other videos. Now, what if you wanted to define your risk on this trade? Well, you could do that. The 5-year note is a smaller product compared to the 10-year note. So I'm pretty comfortable going naked on ZF. But if you wanted to define your risk, you could do that too. And remember, I have all the multipliers for all the futures products in my futures options spreadsheet, which I've shared in a previous video. So if you haven't seen that video, make sure you check it out. Okay, so I could do the same trade, sell the 115.75 put and the 119.25 call. But now to define my risk, I just go further down the options chain on the put side and buy a put, say, a half point wide. And the same thing on the call side, I could buy a call a half point wide. So now that makes it an iron condor. So look at the buying power here. It's taking almost nothing to put on this trade, but I'm not going to get a very big credit on this. Looks like the mid price is trading around 7.5 ticks. So that's the trade-off you make. When you define your risk, you're not going to get a big credit. And if I look at the margin performance of this, so the credit I'm receiving is only $117, but the max loss here is only $500 minus my credit I received. So it's less than $400 as my max loss. And again, I explain all that in my futures options video. Here, the numbers are not quite accurate, I guess, because the market's closed. It's using a different price here for my max return. It should be 117. So the multiplier here is 1,000. So half point wide would be $500. And this is what the iron condor looks like. Now I want ZF to stay between 115.69 and 119.31. So it's a narrower range. So that's the trade-off I'm making. The probability of profit is less now because it's harder for that price to stay in between there in my profit tent there because I'm getting less credit here than I would have on a naked Strangle. That's the trade-off. But this could be a good way to get into a premium selling trade in US Treasuries if it's your first time. You can define your risk and then you don't have to worry too much about if something goes wrong. Okay, well, thanks for watching. Let me know what you think about selling premium in the US Treasuries. Is this a product you would be interested in trading? Do you like to trade any of the other futures products, or do you like to stick with equity options when you sell premium? And if you haven't seen my video on trading the 10-year notes, which is /ZN, make sure you check that out. And thanks for watching.